longtime Miami structural engineering firm. And if you want to speak to me about structural engineering, I'm available anytime. As for why I'm here, I guess I could be called the CFO. I have a lot to do with the firm's finances. Starting with the employee retention credit, when COVID happened, we were all fearful of what was happening. I think most of us qualified for the PPP. I kept reading about the employee retention tax credit. I knew there was something to capture. I thought we could capture it, and I just couldn't find how to do it. Our CPA didn't know how, others didn't. And I Googled and I found an article by David that seemed excellent, seemed to have to be spot on, like he knew everything. And coincidentally, he and Louis worked for the same firm, and I asked Louis about him. He connected us, and David walked us right through it. And I won't get into exact numbers, but we qualified for the 2021 first, second, and third quarter employee retention tax credits, and combined they exceeded either of our two PPP loans. So if any of you can relate to what your PPP loan was, it was very significant. And David has all the answers to it, and shouldn't take you too long to figure out if you qualify for that or not. It'd be amending your returns, but it'd be well worth it. The R&D tax credit I know a lot about as well. I actually started doing it in the late 2000s with another firm that I wasn't too happy about. We kind of dropped it in about 2015. I connected with Louis. It was a CPA firm at the time, and he seemed to have all the answers. And he, we all want with our clients, we want our clients to be very good at what they do, but we want them to work with our style and be flexible. And he was, and we've been through a whole lot in the years since then. Qualified every year, and that's been a significant amount of money. So that's kind of why they asked me to join the call.
That's great. Thank you, Paul. Hello, everyone. It's David Merzel. I'm a partner at Kauffman Rossin. I've been with the firm for almost 30 years, and I have the pleasure of working alongside Louis Guay. My area of expertise, I'm in our entrepreneurial services group, which is a fancy term for closely held businesses, individual business taxation, tax credits, and incentives, which is why I'm here today. I've also had the pleasure of working with Paul throughout the pandemic and continue our business relationship today. Paul and I, during the height of the pandemic, we spent many mornings, sometimes 4 or 5 o'clock in the morning, strategizing, and it's just always a pleasure to work with someone that's bright and challenges you. And we were able to collaborate very successfully with PPP and the employee retention tax credit. So I have some slides I'm going to share. I think we'll hold questions in the chat. And the Q&A session, I think is very important. So with that, let me share my screen, which may be more challenging than the employee retention tax credit. Okay, let's see. Can you see my screen, Louis? Great. Okay, great. So we'll go through some slides. Try to summarize a very complex topic, but just from 10,000 feet, you really can't go anywhere these days without hearing the employee retention tax credit being promoted on radio and television and publications. I'm not a big social media person, but I even came across solicitations on TikTok. I mean, that's how crazy this Wild West has become. The employee retention tax credit was born out of the CARES Act, and the confusion initially was that if you did receive a PPP loan, you were ineligible for the retention credit. And then in late December 29th, the Consolidated Appropriations Act in 2020 retroactively allowed folks who already received or were eligible for a PPP loan to retroactively claim the employee retention tax credit. So the genesis, and this is, by the way, one of the most overlooked credits or programs that came out of the CARES Act. And there's there are many consultants out there that I'd have to caution you on, so much so that the Internal Revenue Service, I haven't seen this in many years, they have a special tip line for abusive practices. And I'd like to sort of categorize these, consultants. When I say consultants, I mean non-CPA firms. There's really two categories. One is consultants that have very good intentions and just really don't understand all the twists and turns of the rules. And then there's just another category that's just way out there, very, very aggressive, charging contingency fees, which we don't charge contingency fees. It's just an inherent ethical issue that we find with that. So now before I get into a few of the slides, the reason there's a misnomer. It's called a credit. So folks believe this is a tax credit that will flow through to me against my income tax liability. It's really not a tax credit at this point. It's really a refund. So this is an actual cash refund for folks that qualify. And the reason it's called a credit was that the intent of the program was to measure your eligibility as you were making your way through the pandemic, and to claim the credit on your originally filed 941, your quarterly payroll tax return, therefore reducing your payroll tax deposit and putting immediate cash in your hands to help you retain your employees. But since it was retroactively reinstated, you're basically not claiming a credit. You're claiming a refund. So this applies to employers that were in business March 13th for the qualifying period, March 13th, which is the official start date of the pandemic, through September 30th of 21. Originally, it went all the way through fourth quarter of 21, but the fourth quarter was repealed. And there are some special programs for startup employers, meaning you started your business after February 15th of 2020. So this was to incentivize and reward folks that had the courage to actually start a business during the pandemic, if you could believe that. Okay, on to the next slide. So there are, in general, there are two paths to qualify. I like to say 2.5 paths. And in general, the bright line is a significant decline in gross income, which in and itself could be a seminar on what is gross income. But basically, gross income consists of all forms of gross income: customers, rents, royalties, interest, dividends, refunds, rebates, sale of fixed assets, less basis, everything other than loan proceeds. So PPP or a bank loan or a owner partner stockholder loan. And what you're doing for this path is, assuming you've been in business for 19, you're always comparing qualifying quarters in 2020 and 2021, always to the same quarter of 2019, right? Pre-pandemic. And it's somewhat counterintuitive that the qualifications were much more stringent for 2020 than they were for 2021. But in general, when measuring your gross income decline, and again, this is using the same method that you use for income tax purposes, which can be different than your financial statements. So you're using accrual or cash, completed contract, percent complete, whatever method you're using for tax. And if you experienced a greater than 50% decline in 2020 as compared to the 2019, then that becomes a qualifying quarter, okay? There is a mechanism, without getting overly technical, in that if you qualify for one quarter, you in general will qualify for two. And that's because you continue to be eligible for the credit until the last day that follows the quarter to which you restore your receipts to 80% of 2019. Fancy way of saying you get 2 for 1 here. And further back in the presentation, I'll show you the interaction with the other programs, PPP most important. Then 2021, they turbocharged the credit and lowered the bar to entry. So instead of 50% decline in gross income, that's been substituted for just a 20% decline as compared to 2019. Okay, this does not have to be pandemic related, this path. This is just a revenue decline. There are special rules for nonprofits, but that's not really the audience here. And interestingly enough, is that if you have a foreign operations, let's say you have a foreign parent owning a U.S. company, the income is includable for all entities, including foreign, which is a little unfair, since wages paid to non-U.S. folks do not qualify for the credit. If you did make some acquisitions or bought and sold companies along the way, there's some nuances there to what am I? How do I measure my 2019 receipts and headcount if I made acquisitions along the way? Path 2, not quite as a bright line, and this is where the abuse comes in because it's fuzzy to some folks depending on their motivation. So the second path, and you can, by the way, you can use path 1 and path 2 to extend your eligible quarters from 2020 through 2021. This is this path to qualify is a full or partial suspension due to a government order that limits travel, commerce, and group meetings. Very, very broad. But what the takeaway here is that this must be a government order, not a recommendation, not best practices from the CDC, not folks standing on the news saying this is what we recommend. This is a government order. We call them EOs, emergency orders, and this can be state, local, federal, any government agency that can impose some sort of restriction or a fine on your business. Two very simple examples that we can all relate to. You have a restaurant, government order says, limit your dining capacity to 50%. There's a very clear full or partial suspension. And in some cases, modifications to the work environment would qualify also. That would be, limiting capacity to things of that nature. Now, the government order must be on your business, and whether or not it's enforced is irrelevant. If you did have we're speaking to mostly professional firms here. If you did have the ability to pivot to a remote environment, even if you did not, if you had that ability, you really don't qualify here. It's important to distinguish that just simply wearing masks and having to social distance in and itself is not universally applied. So and when I said there's 2.5 paths, there are instances where supply chain disruptions, if you're in a type of business where you just simply could not get supplies because of a government order on your vendor. But again, with professional services, this may or may not apply. Let me see. Let's go into something important here. This is often overlooked. There's aggregation rules. And what aggregation means is that all entities under common control are aggregated to test path 1 and path 2. So if I have one company that I own, 51%, and I have 3 other companies, when I'm applying these tests, revenue decline or full or partial suspension, you look at this as a single employer. And if one entity, if the aggregated group qualifies, the whole group qualifies, which is really amazing. We had a situation where we have a Florida-based entity, and they have their big warehouse operation in the port in Los Angeles, and the port was closed due to a government order. And although they're here in Florida, that had a more than nominal effect on their business, and the whole group can qualify. Okay, so once you've now determined the quarters based on path 1 or path 2 of your eligibility, you can start getting into some of the other requirements. This is a case where size does matter. And so, of course, the qualifications changed from 2020 to 2021. But in general, if you had less than 100 full-time employees during 19, then and you qualify for 2020, then all of your wages qualify. Okay. They substituted 100 to 500 for the 2021 credit. Again, always based on 2019 full-time employees. Full-time employee is different than full-time equivalent under the PPP rules. And the significance here is that if you exceed this 100 or 500 based on the year, is that instead of all wages qualifying, only wages paid to employees while not working qualify. What does that mean, not working? Well, I sent everyone home because we were required to close. We have 10,000 employees. If I continue to pay while you were not providing services, those are the only wages that would qualify, as opposed to remote workers. The amount of the credit, again, it's sort of reverse, counterintuitive. I view 2020 as sort of a more pronounced pandemic, but I guess that's based on your own personal experience. The maximum credit for 2020 is it's always based on $10,000 of qualified wages, and the maximum credit is 50% for the entire year. So one employee, if you qualified for 1, 2, or 3, or 4 quarters, when we put together the calculations for this, only the first $10,000 of wages qualify. 10,000 times 50% is $5,000. For 2021, really turbocharge this. So instead of $10,000 per calendar year, it's $10,000 per quarter times 70% instead of 50%. I know that's it's a little counterintuitive, but it's remarkable. So for example, let's just say hypothetically, you qualified for all of 20 and all of 21. Your maximum credit would be $26,000, and these are the advertisements that you're hearing, and that's $5,000 for 2020 and $7,000 for 3 quarters of 2021. Okay, because it was repealed for 4th quarter. Certain employees are not eligible, and there's some special rules for owners of greater than 50% and their relatives that are on payroll. Okay. Interaction with other programs. I have, the skill set I have started with PPP. So I've been involved in close to 500 PPP forgiveness applications, reviewing those and directly submitting to the SBA during that process. And there's a lot of interaction between the programs. The basic rule is just that you cannot use the same wages twice for both programs. So if you used wages to help you claim PPP forgiveness, you cannot also use those same wages for the employee retention tax credit. There was a clarification in a very important IRS notice 2021-20 that is, sort of public information, and it's a part of a series of guidance from the Internal Revenue Service. And it was a very, very important notice in that it clarified there that you can use excess wages from your PPP covered period. What that means is that, let's say you had a PPP loan for $500,000 and you claimed $1 million on your PPP forgiveness app because you used a 12 or an 18 or a 24-month covered period. Initially, the rule was, well, if you claimed it on your application, you cannot use this for the retention credit. And IRS Notice 2021-20 provided a safe harbor that says, as long as you don't use the same wages twice, then you can do that. This is very, very often overlooked by the payroll companies, by the consultants. And this is really where the skill set comes in, is that we're able to harvest every penny from the covered period, in addition to other qualifying quarters outside of your PPP covered period. In addition to PPP, you cannot use same wages for other programs. If you claimed any of the COVID sick leave credits, FFCRA, which is the Family First Coronavirus Relief Act, and the FMLA, which is the Family Medical Leave Act for folks that were sick with COVID, taking care of someone with COVID, or had children remote schooling and you had to stay home. There were some special programs there. And of course, you cannot use the same wages for the R&D credit. So you can see this logarithm and why it's not as simple. And since we've prepared so many of these, we have a team, CARES Act team. I head up the team, and we harvest every penny to make sure you're maximizing R&D, ERTC, some of the sick leave credits, and of course, your PPP forgiveness. There's some other programs that are out there in case it applies to anyone, but you also cannot use the same wages for the Restaurant Revitalization Fund or the SVOG, which is the folks that are promoting events. So I'm not sure that applies to this group. Okay. Once the qualifications are determined, which we help with, we also help you read through your emergency orders and determine which quarters you're eligible for. The way that you claim the credit / refund after it's calculated is that you go back and amend the 941, which is your quarterly payroll tax return for that particular affected quarter. Okay, there's some anomaly in 2020 where quarter one gets amended with quarter two, but I'll spare you that. And so once the calculations are done and all of the support and documentation, you can amend your 941. We amend them. You can coordinate with your payroll service provider. It's also important to note that if you do use a PEO or a leasing arrangement, which has become quite popular these days, you're still eligible for the credit. This just means there's one giant consolidated 941 for many companies that are aggregated together through a leasing arrangement in order to help you save on group benefits and things of that nature. PEO leasing, you're still eligible, but you should check with your leasing company first because they follow their own rules. Okay, regardless of what the Internal Revenue Service rules are, they have windows where they'll allow you to amend and so forth. Another very important piece here that is often overlooked is that unlike PPP, which I hope we never see it again, but what a program. Free money, and the expenses you paid with PPP were deductible. So it's really a double benefit. So I received $500,000. If I use it properly, I do not have to pay it back, and I can claim a tax deduction when I pay those wages. The employee retention tax credit is not quite as generous, but still an amazing program. And the mechanism here is that to the extent you receive, or I should say claim an ERTC credit, I'm going to say this slowly because it's a tongue twister. You reduce the deductible wages in the year that gave rise to the credit. So if I, for example, paid $1 million worth of wages in 2020, and I am eligible for a $100,000 ERTC, my deductible wages are reduced by the $100,000, effectively making it taxable. Okay, that comes as a surprise to folks. And also, there's a misconception that, well, I'll amend or I will include the income in the year I receive the refund. That's not the rule. You have to go back and amend. There are some outs for partnerships and little outside the scope of this, but some partnerships do not need to amend if you make certain elections. And as I previously noted, and it's worth repeating, no interaction with R&D. Okay, that's a real basic overview of the retention credit. There's a lot more to it. We're here to help. I do this every day, and the importance of the deadline and I'll leave off with this, is that the misconception is that you have, well, not misconception, but let me clarify. The due date is the later of 3 years from the original due date or 2 years from the date you paid the tax. Okay. What this means in the IRS code is that all timely filed 941s, doesn't matter what quarter it's for, are considered filed by April 15th of the following year. Okay. So quarter one, quarter two, quarter three, quarter four, as long as I filed those timely, they're considered timely filed by April 15th of the following year, which means that there's plenty of time. 2020 would be due April 15th of 24. And the 2021 credit, if you missed it, would be the April 15th of 25. So we'll be doing this for quite some time. Once you submit the 941X, which is the amended, you won't believe this, but the IRS does not accept these electronically. These are all paper claims to an agency that has trouble with paper. So there is a mountain of backlog that they're trying to work through. They promise, 3 to 6 months. I can tell you, the larger the credit, the longer it will be. Some we've received, 3-6 months. Some, unfortunately, are over 12 months. Once it's filed with the Internal Revenue Service, it's out of your hands. It's out of our hands. We do check up to make sure they receive the credit. So you want to plan accordingly for that. That's a basic overview. We will share our contact information, and as Paul mentioned, we're here to help you. And I'd like to hold the questions until the end, and I will turn it over to Louis to discuss R&D.
Thanks, David. That was very, very interesting. I'll try to share my screen now. Let's see. Do this. We'll get into the R&D tax credit. And I'll try to be brief because I want to keep some time for Q&A and also exchange with Paul. So the R&D tax credit, and it's unrelated to COVID or the pandemic. So something that's been around since 1981. Just another very interesting tax incentives for you guys to consider. And I'll skip some of these slides to get right into it. Again, it's a tax credit, and this one, whereas David was saying that it was not the employee retention tax credit was not against federal income taxes, this R&D credit is applied against a federal tax liability. It's a dollar for dollar offset. So if you owe, say, $300,000 in taxes to the federal government, and you have an R&D credit of $50,000, now you're lowering that $300,000 by $50,000 to $250,000. So it's really applied against a tax liability. It is a tax credit that is based on expenses. Okay, it's not a grant. It's the more you spend in R&D, the higher the credit will be. It's called a credit for increasing research activities because there's a component in the way that we calculate the credit that looks at how your R&D expenses are evolving through time, and I'll get into this in a minute. But generally speaking, so the credit is a dollar for dollar against tax liability, but the credit is not dollar for dollar based on the expenses. So rule of the thumb, say 8 to 10% of your R&D expenses, that's going to be the amount of the credit. So if you spend $1 million performing R&D, $80,000 to $100,000 in tax credit is what you can expect. We call the R&D expenses qualified research expenses. So if I refer to QRAs in this presentation, that's what it means. And qualified research activities, QRAs, which are the activities on which you are conducting, you're spending money to perform R&D. And those activities, one of the misconceptions sometimes is that we think that because it's called R&D, it's going to be just for technology companies or biotech or manufacturing where you have scientists and engineers and labs, but that's not the definition for tax purposes. Is very broad. There's a lot of room for interpretation. There is guidance out there that shows that architects and engineering firms have been claiming the R&D credit and have sustained claims in the past. Not to say that the IRS really likes it. To be honest with you, they've been trying to find ways to push architects and engineers out of it. They haven't been successful. All the cases that have made it to courts have been favorable to taxpayers. So A&Es to this they continue to claim the R&D tax credit, and based on the code and the guidance that is there, are entitled to claim it. We'll see how things evolve. The R&D tax is continuously evolving as we get more and more, guidance out there. But again, since '81 and until now, it's still available to architects and engineers. And I'll have a little bit of this discussion with Paul in a minute about that topic and on how your activities potentially qualify. But real quick, how the R&D credit can be used. Again, here, most of you will be on this side on the offset income taxes. We'll talk about payroll in a second, but so you would use the credit against federal income taxes. There are states credits. The Florida state credit for R&D is not very generous. It only applies to C Corp. It's not a guarantee. It's a first come, first serve. There's a cap. So we're not really going to touch it today. I haven't done it for architects yet here in Florida. We've seen it with some large technology company, but generally speaking, the cost of pursuing that credit, having to file with the Florida government is not worth it. So it's mostly going to be at the federal level when it comes to R&D. If you do not have taxes because of certain situation, you're not profitable for a given year, you can carry forward the credit for 20 years, or you can go back and amend a prior year and use that credit against taxes paid in a prior year. If you are a C Corp and you're planning an exit, you sell the business, you add credits that had not been used yet, those credits will transfer with certain limitations to the buyer. So there is benefit in having these credits claimed, even if you cannot utilize them, especially if you're planning an exit of a C Corp. Most of you are most likely in a situation where you're an S Corp or a partnership. In that case, as you know, the entity itself is not taxed. It's the partners and the shareholders are getting taxed. So that credit will flow through K1s and be allocated to each of the shareholders or partners. If you're a startup, if you've been around for less than 5 years and you have less than $5 million in gross receipt, you can utilize the credit against payroll taxes. That would be in a situation where you're not profitable, you don't owe taxes at the federal level, and you still want to benefit from the R&D credit, you can use it against payroll taxes. Again, it's limited to less than 5 million in gross receipt. You cannot have gross receipts for more than 5 years. So if you've been around for more than 5 years, you're most likely out of this scenario here. And it's limited to $250,000 of payroll taxes per year. Most of the firms that I know through AIA have been around for several years. So this is not really an option. And most likely you're going to be offsetting income taxes with your R&D credit. 3 types of expenditures, but really for architects and engineers, only 2. Wages. So the W-2 wages that you pay your employees, if they are performing research on your behalf, you can include their taxable wages as an R&D expenditure. Supplies would be in the case of somebody that develops tangible products like manufacturers or technology companies. If they use raw materials or parts and prototypes, for example, these will be includable. In your case, it's unlikely that we're going to have supplies. Contract research. If you have contractors that you're paying through either you have a contract with them or you pay them through a 1099, as long as they are US based, if they perform research on your behalf or on your behalf, 65% of their costs are eligible for the R&D credit calculation. So a little bit less favorable than your own employees, which you can include the total wages that they spend doing R&D for you. 2 ways to calculate the credit, and most likely you're going to be on the alternative simplified credit side. So what we call the regular credit computation involves your gross receipts and going back to the inception of the company. So if you've never claimed R&D and you've been around since the 80s, for example, it's very highly unlikely that we're going to be able to compute a regular credit, because that would require us to go back into your tax years of the 80s when you started and figure out how much R&D you had at that time, how many people you had at that time, it becomes very burdensome. It's very hard to substantiate. If you've been recently formed, it's a little different story. There's potential to go and claim this regular credit if your gross receipts are still relatively low. But most of the time, you're going to be on the alternative simplified credit. And what that means is that in calculating the R&D credit, we compare your R&D expenditures to your prior 3 years. Remember when I was saying it's called the credits for increasing research activities? So they want to see some sort of increase through the years. We're not comparing one for one. You're comparing with 50% of the average of the prior 3 years. You take the total of your R&D expenditures for the prior 3 years, you divide that by 6, and that's the amount that you're going to have to subtract from your R&D expenses for a given year, and that's on that amount that your credit's going to be computed. When I gave you earlier the 8 to 10% roughly of your R&D expenditures, it takes all of that into consideration. Okay, so if you want to remember one thing, it's 8 to 10% of your R&D expenditures, and this is where people like us come in and figure out how to calculate it and how to build that 3-year basis. But just know that if you are going to claim R&D credit for the first time, what it means is that we're going to have to look in your R&D expenses for the credit year. So let's say 2022, but we're also going to have to evaluate the prior 3 years. Even if you're not claiming that credit, we have to establish that baseline, which is then going to behave like a moving average. You're not going to have to redo it every year. It's just going to remove 1 year, add 1 year, and so on. So once you've done that 3-year basis, it becomes a little bit less burdensome to claim the R&D credit. Do I qualify for the R&D tax credit? That's where it becomes interesting. So in general, we say that qualified research occur when anywhere there's a tangible product, there's software or a transformation process. In your case, you may already say, well, there's no tangible product. We work on designs, but the design per se, the construction documents at the end of the day that are the result of all that R&D can be considered so far based on the tax courts as a tangible product. And the R&D tax code is like I said, it's one of the most complex section of the Internal Revenue Code. And I'm not going to get into all the details about the rules and the requirements, but just in general, you'll often hear about what we call like a 4-part test to figure out if the activities qualify. And that 4-part test is listed there. So are you developing a new or improved product, process, system, or software? Again, I'll tell you guys to consider your design as a product. Are you facing technical challenges and uncertainties? Was there an uncertainty at the beginning of your project as to how this design was going to be accomplished, how the objective to come up with a design for a particular building can be achieved? And from having worked with some of you, from having worked with Paul for several years, I understand there's always more than one ways that the building or the design can be put together. So generally speaking, this is something that is not necessarily that difficult to substantiate in your case. Evaluating different alternatives. This relates to what they call a process of experimentation. They want to see that you are set in a way where you can evaluate different designs, different paths to how you're going to accomplish your objective. If you succeed on alternative or design number 1, good for you. It doesn't exclude you from claiming the R&D credit, but you want to show that you were set to evaluate different design, compare their efficiency, or compare the total costs associated with it, or the impact on the building's performance or functionalities. You want to show that there's more than one way that this can be accomplished. And lastly, principles of art science, computer science, or engineering. And generally speaking, for architects, we consider that you fall under the engineering side of things. Again, keep that in mind. This is for tax purposes. I know the architecture versus engineering is different, but the tax code doesn't make that difference. All right, R&D activities for A&E, and then I want Paul to chime in a little bit here without throwing you under the bus, Paul. But so know that it's project by project basis. Okay, we're not just looking at your total wages and saying, all right, we're going to include all these architects and claim them as R&D. We have to look at it, evaluate the eligibility, the 4-part test that I just showed you as on a project by project basis. And the second bullet, I've put ideas, and again, it's not an exhaustive list, and it's not what you're limited to, but just think about it. I mean, most of the time, not all your projects will qualify, But what we like to look into are these projects where, and again, I've put unique design first, and all of you will scream at me, say, every building is unique, all the designs are unique. I understand it. But what I mean is that if there's such a thing as a very simple building, again, which I know doesn't necessarily exist often, but 4 walls and a roof, most likely not gonna qualify, like something very simple, like simple box. But think about it from, complex designs, special conditions, technical complexity, projects in which you have environmental, geometrical, or spatial constraints, special functionalities that you're trying to incorporate in the building. If we're dealing here with energy efficiencies, special materials, limitations, renovations of old buildings is one that, again, through Paul, I've learned to like much more than when I started doing this. Understanding the complexity of a building that was put together before the new code and having to renovate it and bring it to code. So these kind of projects, these kind of situation or scenarios are where most likely your projects, your eligible projects will be. And Paul, maybe you wanna say a few words here. I mean, I remember when I started doing R&D with you here, as Colleen mentioned early on, I'm originally from Canada, so I worked in the R&D program over there, which is very different, very stringent. Over there, architects don't necessarily qualify often, but you walked me through, the complexity and how different ways that a building can be designed. Any thoughts here to share with our friends about eligibility and how you approach it? What made you feel confident that your projects involve R&D activities? You're muted, Paul.
My apologies. Looking through some of the names of the participants, there's architects, landscape architects, civil engineers, MEP, builders. There's all a series of people. So I can mostly speak from a structural perspective, but if anybody looks at designs by any of their competitors, sometimes you're shocked at the way they solve the exact same problem. They're given, here's a building to design, and they're just so unique. When you talk about R&D, we compare it to the other extreme, like an automotive factory, where everything has to be exactly the same every single time. And once on the factory floor, there's no R&D involved. But an architect in particular on a regular building, they start with a plot of land, a certain budget, certain goals of what this is supposed to be, and the number of stories, the story height, the length, the width, the how much glass, where, what type of MEP and how that affects it, the roofing, everything is quite different. It's based on market forces. It's based on what the builder wants, what your other engineers want. And it takes judgment, experience, education to do these things. And you can't really spit it into a computer and get it all by itself. It takes years and years. And when I look at structural, you have the materials, the framing systems, the concrete strength, how you're doing the rebar. There's just there's challenge after challenge that, while we may not think it's rocket science and we do it every day, the fact is that if you let somebody who's not so experienced do it, they're going to come up with something quite different than you, and you might be shaking your head of how could you do that. But in a lot of cases, it's just different, and that requires, that's the R&D component, is the human judgment, what it does, and there's no replacement for the human judgment. And that's what the US is trying to encourage, is more of this, quote, R&D, more of this, us investing in our firms, investing in our people, becoming stronger and stronger, to developing more superior buildings.
Thanks, Paul. Thanks. Very, always like to get your perspective on it, and it's exactly aligned with the way we see it. Real quick, just because I see time flying, and I want to leave time for Q&A, and we're going back to David if there's any question on the ERTC. A&E, as the way you operate most of these projects, one particularities that you have is that you're going to be conducting your R&D projects under contract. You're working on the design for somebody else. So one rule that you have to respect is only the projects that you are conducting under a fixed fee can be included in the R&D credit calculation. anything that is done under times and material, and even a not to exceed, which I know operates like a fixed fee, but there is unfortunately clear guidance from the tax courts that they would not be includable. Only fixed fee projects can be included. And the thinking is that when you're paid on the fixed fee, you're paid for your for the results of the design. You're paying, and you're the ones at risk to go over. And if you have to invest more resources and time in coming up with the design, you're not going to be compensated more. Whereas if you're on a times and material and you can charge all your time to your client, they're the ones that are kind of taking the risk. So just keep that in mind, only fixed fee projects. And in general, when it comes to the activities, not all activities will qualify, but those that are most likely to qualify, design build bids, technical requirements, all the iterative design, all the cycles of designs, evaluation of design alternatives, and also construction documents, as long as there's a design uncertainty that exists, as long as there's still a chance that the design will be changed, or that you're still trying to solve some of the challenges that you've encountered, you can include all those activities. And in general, again, exclude construction administration, peer reviews, inspection and administrative tasks, and as I said, all times and material and not to exceed projects. One caveat or one recommendation that we often see regarding CA is that in your time tracking, you're gonna have CA associated with certain projects, and sometimes your people will not necessarily carve out redesign that occurs during CA. So if there is redesign done during the CA phase, that redesign or any work done around fixing the design can be included. Much better if it's coded as designed and CA in your documents, but it's something that we look into when we see CA. We ask, were there any design work done at that phase? Real quick, I'll skip, but this is our process. And again, we'll send some of these slides to you, but just know that the process involves some engineers from our team and some of our accountants to sit with you, to go through your list of projects, to ask technical questions, documenting those projects. We'll review the time reports if you have some. We'll do all the crunching with the numbers, come up with the R&D credit calculation. And real quick, I have to disclose that it's a challenging year to start claiming R&D expenses, the R&D credit. Sorry. There is a new requirement. There's a new law that kicks in 2022 that requires you to capitalize and amortize all your R&D expenditures over a period of 5 years. So anything that is called an R&D expenditure will not be fully deductible in the year incurred and will have to be amortized over 5 years. So think about it this way. If you claim the R&D credit and you say that you have $1 million of wages that are for R&D projects, until now you were deducting that $1 million of wages. Now you're not allowed to deduct that $1 million of wages. You have to amortize it over 5 years, which with a mid-year convention means 6 years, which means that year one, you only get 10%. So if you have $1 million of R&D expenditures this year, you're only deducting $100,000, and you're pushing the other $900,000 to be deducted in future years. This is not good. This comes from the 2017 tax reform, by the way. It was introduced as a way to allow the other favorable provisions, like reducing the corporate tax rate to 21%. They gave it like a 5-year break until it kicks in, thinking they were going to fix it. They didn't fix it. And as of now, it hasn't been fixed. We do think that it's going to get fixed in the near future, but near future now means probably a year or two. This is not going to stay around forever. There is support on both sides. It's just politics. It's just they need to get it done. Unfortunately, for 2022, it's likely going to be in place. But we are taking provisions to make sure that our clients are protected. If there's a fix later in the year, we can reverse and go back and adjust for expensing those costs. By definition, it's not related to the R&D credit per se. So it doesn't mean that it's not applicable only for people who claim the R&D credit. If you have R&D expenditures, you are required to capitalize them. Where it gets gray is that in your case, if you've never claimed the R&D credit, are your projects really R&D? Are they not R&D? It's a discussion to have with your CPA. Are you at risk of getting the IRS saying all those wages should have been capitalized, not deducted anymore? So there's strategic planning to be done here. And Paul can comment on that, because we've had several discussions, and I know he's looking into it deeply and coming up with what we hope will be the best strategy. But it's unfortunate. It's unlikely to stick around, but just know that if you are going to claim the R&D credit, there's absolutely no way around it. You're going to have to capitalize the wages that you include in your R&D calculation. If you've never claimed the R&D credit, maybe this year, and again, we usually like to get you guys to claim what you're entitled to, but maybe this is not the best year to get started. But still, in the long term, it does make sense to claim the R&D credit if you're entitled to it. Paul, you want to say a word on that? I know it's a delicate matter, but and you're muted.
My apologies. What I would say is it's a very complicated topic. Both of them are, and speak to Louis to understand it. Yes, it may not be the best year to start on it, but if you've never done R&D, you've never looked into it, you've never educated yourself, you've never been in a position to do it, my suggestion is educate yourself now, be prepared for it. I agree with Louis. I believe it's going to change in the next year or two. I agree with him. It's probably not the best year to start doing it, but we all kind of kick the can down the road. Oh, I'll worry about it later. And I suggest get educated now. And then when things become favorable, you go into it, because for us, it's been favorable for many years. Been doing it with Louis for like 7 or so. And it will become favorable again. It's a lot of tax credit passed through to the owners, and not a big fee to gain it. Not that difficult for your staff to do. So get educated now. And in a forum like this is not enough to get educated. It's enough to whet your appetite. And if you think it's something you may want to go into, then reach out to him and he can have more detailed conversation. So at least you have all the facts.
Thanks, Paul. I know we're running out of time. Colleen, do we have pictures, not pictures, but questions, sorry, in the chat that we'd like to go through?
Yeah, look, Colleen and Louis, I see some questions in the chat. So why don't I address them?
Sure.
They seem to be related, so I'll qualify. So the genesis of the question is, we received a PPP loan using all wages. We were unable to obtain a second PPP loan because the funds run out. Does that mean we qualify for the retention credit? So I think the author of the question doesn't actually mean the PPP funds ran out, because actually the PPP funds never ran out, but there was a deadline to apply. There was actually a surplus, which is really remarkable. And what this means, let me clarify, because the other questions are all similar to this, is that if you qualify based on gross income decline for 20 and 21, as I mentioned, comparing it to 19, or a full or partial suspension due to a government order, you qualify. The only significance with the PPP is that depending on the covered period that you claimed, you could have covered period means the date range where what I put on my forgiveness app, where I'm claiming this is how I spent my money. That could be anywhere from 8 to 24 weeks. The only significance here is that you can't use the same wages twice for both programs. However, you'd be surprised that it would be almost impossible to only use the exact amount of wages for PPP forgiveness. You may have claimed rents, you may have claimed utilities, you may have claimed more payroll than you needed for full forgiveness. So again, my loan is $500,000. I claimed all of my employees, but that totaled $600,000. You have $100,000 of excess that you really didn't need to claim for PPP, and you can reorganize the wages from that period to claim the retention credit, as long as the person was paid in that qualifying quarter. So they're really kind of mutually exclusive yet related. It doesn't mean that since you did not receive a PPP center run, you automatically qualify. It's the same rules. Revenue decline, or the government for the better of the community interrupted your business in some fashion, we will reward you for retaining clients, retaining employees. And that doesn't mean that you did not have a decline in employees. So if you went from 10 to 5, the 5 employees still qualify. It's a little bit of a tricky area. So I encourage anyone, we'll share our contact information. I'm happy to field some phone calls because I know this is a very important topic, especially for this group. So with that, I personally would like to say thank you for everyone to make the time. To Colleen, Paul, and Louis, thank you for allowing me to join.
Can we
Thanks,
do
David.
one quick question that
Yes.
came to me directly? Sorry.
Yes.
It was from
yes,
Jason
yes.
Hagopian, and he says, my company is only 2 years old. Do I just use 1 year as the baseline for calculating the base amount? And then he says, I thought that was
It's a great
yeah.
question.
Mm-hmm.
If you started your business after February 15th of 2020, there
Mm-hmm.
are a separate subcategory of eligible quarters for the employee retention tax credit. If you notice, I kept mentioning it expired September 30th of 21. If you did start your business after February 15th of 20, that category and one other category, a severely financially distressed entity, are eligible all the way through the fourth quarter. So the answer is yes. You're still eligible, and there's different ways to calculate the base period. If you started your business, not sometime during 19 or even in 20, and we can help with that. For folks that started after February 15th, you're eligible for the recovery startup ERTC in quarters 3 and 4. And regardless of how many employees you have, the maximum is a $50,000 refund per quarter. So $100,000.
And David, there are 2 more questions for R&D, but there's another one for PPP and also for Jason. If the question also related to R&D, I can discuss it with you, but yes, it will be only based on the 1 year prior to your credit year. So if you don't have 3 years of existence, there's special rules that I can walk you through it. It's not favorable, let's say. So it's not a problem. And David, before I go back to R&D, because there's one more.
There's a question at the bottom. Let me just scroll through that.
Why don't you take it for PPP?
Let me see
if your wages were included in the PPP and your loan was forgiven, if you apply for ERTC, do you have to amend the PPP loan?
No, you do not, because you're not using wages twice. If you use them for forgiveness, you had a $100,000 loan and you only needed $100,000 for PPP forgiveness, you could use any other wages for the retention credit program in the qualifying quarter. So there's no way to go back and amend your PPP loan. That ship has sailed. If you were granted forgiveness, you submitted your application through your bank's portal. They submitted it through the E-Tran system to the SBA, and you receive your forgiveness letter. You're still subject to audit for 6 years, so I encourage you to hold on to your support. But there's no way to rescind that even by filing an appeal. But the PPP is worth more. So in the hierarchy of where should I use wages first, PPP forgiveness, retention credit, and then the interaction with R&D.
Cool. All right, I'll cover real quick the 2 R&D questions. As GC, our architectural costs for building special homes qualify for the R&D credit? Very unlikely. Would have to look into the contract, but most likely it's the architects who actually qualify for that design and can take the R&D credit. And the other question, it's a very interesting one, I guess, and it keeps me up at night and keeps up clients at night. If we have done R&D in the past, do we have to do it this year, given the issue with amortizing over 5 years? It's a matter of strategy. It's a matter of planning. All I can say is, if you used to call there's a consistency requirement. If you've called something R&D in the past and you stop calling it R&D because the treatment is no longer favorable, that can raise a red flag. Do you want to go down there and take that chance of raising a red flag? And then if it gets fixed in a year, you start again calling it R&D. I mean, it's a matter again of strategic planning. I prefer an approach of saying, let's not pull the plug entirely, but let's maybe modulate what we include this year. if there's, if there's a year again to not start R&D or not to be too over aggressive on R&D, maybe it's that year, or maybe, you stay the course, this gets fixed next year, and it's just a 1-year deal. But you just have to be careful. If you used to claim R&D and you suddenly stop and say January 1st, 2022, I had no more R&D at all, and you've claimed R&D for the last 10 years, that's the kind of thing that can raise suspicion.
Louis, this is Aida Curtis, the one who asked the question, but we still have to show that we did more R&D this year than last year, right?
Well, depending on how you calculate the credit, you don't necessarily need to show that you do more. The way it's calculated, again, it's based on your prior 3 year, the average 50% of the average of the prior 3 years. So
Okay.
you have years that you can be down.
Okay.
What cannot happen is you cannot be down like 5 years in a row where you're almost cutting entirely your R&D. At that point, your credit's going to be zero.
Got it. Okay.
But if you show something consistent or even a slight decrease, a decline, it's not going to prevent you from claiming the credit, and maybe it's a little bit more favorable. But again, it's a matter of planning and discussing it with your tax advisors.
Thank you.
You're welcome.
Gentlemen, I promised you it would only be an hour, and we're just about at an hour. I'm going to send everyone a link to the video. Once it's up, it'll be probably towards the end of this week. And are you guys okay if I put contact information for you all in there?
Please.
Yes, please.
Okay,
Please do.
so thank you all for attending again. Check out AIA Miami at www.aiamiami.org for upcoming events and programs like this. And thanks, Louis and Paul, and thank you, David, so much for coming back and helping us out with this. We really appreciate it. It's a great program.
Pleasure.
Thanks, Colleen.
Thank you, everyone.
Thanks,
you, guys.
everyone.
Bye.
Bye.